Hello, everyone. Welcome to Talk Talk Speak podcast. Today, we're plunging into some really interesting currents we've seen lately in the U.S. financial markets.
Yeah, definitely some intriguing moves.
Think about it. More gold coming in, some back and forth with treasury bonds, the stock market doing a bit of a jig, and everyone trying to guess what the Federal Reserve will do next.
A lot happening all at once.
Exactly. And the question we're asking ourselves, and for you, is this all part of some grand financial script to keep the U.S. on top globally?
Or is it just, the messy reality of a complicated world reacting to events?
That's what this deep dive is all about. We want to cut through the confusion, connect the dots for you.
We've sifted through a ton of information, articles, studies, our own notes.
Right, and our mission here is to pull out the crucial insights from all this financial activity, basically giving you a fast track to understanding these big shifts.
Okay, let's unpack this. Where should we start? Gold.
Let's do it. Where better to start than with something that's been valued for centuries? Gold.
Okay, so what's fascinating to consider is this idea, this theory really, that the U.S. might be deliberately making itself attractive to gold.
How so? Like actively trying to pull it in?
Some theorists suggest that maybe tax policies could be at play, things that encourage bringing assets back home,
Repatriation incentives, perhaps?
Exactly. Which could, indirectly at least, boost gold reserves and give the U.S. more sway in the global gold market. It's a narrative that hints at a calculated move to strengthen financial muscle.
Right, a deliberate golden attraction. It sounds almost like a financial magnet. But when you look at the actual numbers, does it hold up?
Well, that's where it gets interesting. The picture becomes a bit clearer. The U.S. already sits on a mountain of gold.
The world's largest stash, isn't it?
It is, around 8,133.5 metric tons. Plus, its influence in the gold world is already pretty significant just because of where it stores it.
You mean like Fort Knox and the New York Fed?
Precisely. The New York Fed even holds over 6,000 tons belonging to other countries' central banks. So they're not exactly starting from zero in terms of influence or holdings.
Okay, so they already have a lot of gold and influence. What about the recent import figures then? Have they actually increased?
They have. And while it's true that gold imports have increased, the reason why is key. In 2024, the U.S. imported $16.478 billion worth of non-monetary gold.
Which was an increase.
Yep, a $959 million jump from the year before. And that upward trend continued into early 2025. February saw $2.502 billion in imports.
Wow.
Which was a substantial $746 million increase compared to the previous February. Interestingly, gold exports actually saw a slight dip.
Okay, so imports are up, but what's the real engine driving this? Is it policy or something else?
This is where it gets really interesting. The evidence really points towards, a classic market response, not so much a top-down policy strategy. Meaning with all the geopolitical hotspots and economic jitters globally, investors tend to seek out safe haven assets.
And gold is the classic safe haven.
Often seen as the ultimate port in a storm, yes. We saw the price of gold really take off in April 2025, didn't we? Hitting around $3,319.90 per ounce.
And forecasts were even higher for later in the year.
Right. Market predictions suggested it could climb towards $3,720.38 by year-end. That kind of price surge strongly suggests investor demand is the main driver.
So the big takeaway here isn't some secret government plot.
Probably not. It looks more like a powerful illustration of how global instability directly fuels demand for the oldest safe haven asset.
Yeah, if you connect this to the bigger picture of global uncertainty, the increased appetite for gold makes perfect sense as a flight to safety.
Exactly. And getting back to the tax policy angle, while it's true that broad tax policies could have indirect effects on capital flows.
Like tariffs or those repatriation incentives we mentioned.
Sure, but we simply don't see any specific policies that are explicitly targeting gold itself. Even proposals like the Fair Tax Act of 2025 that had no direct bearing on gold.
Okay, so when we weigh it all up, this idea of an intentional gold grab by the U.S., how credible does it seem?
That's the key question, isn't it? Based on what we've seen, I'd put its credibility at maybe medium, leaning towards lower, perhaps.
Medium? Why medium?
Well, the U.S. certainly benefits from being a destination for these safe haven flows. That part's true. But it looks much more like a result of market forces reacting to global events.
Than a deliberate policy to actively hoard gold.
Precisely. It seems more like a consequence than a plan.
All right, that makes sense. Let's move on from gold then. Another fundamental part of the U.S. financial world. Treasury bonds.
Ah, yes. U.S. debt. Always a hot topic.
There's been some talk, some chatter suggesting that foreign investors are losing interest, that they don't want to buy U.S. debt anymore.
Right, the narrative that the U.S. might be forced to buy its own bonds to prop up prices and keep borrowing costs down.
Exactly. What's the real story there? Is demand actually drying up?
The data actually tells a very, very different story. The idea that no one wants U.S. debt, well, it simply isn't accurate.
What are the numbers saying?
In February 2025, foreign holdings of U.S. Treasuries actually reached a new peak, $8.817 trillion.
A new high. Wow. So much for losing interest.
Exactly. And in that same month, we saw significant net purchases of long-term securities, about $142.7 billion. Plus, a substantial $73.2 billion increase in short-term Treasury bill holdings.
So people are still buying, both long and short term.
Definitely. The persistent demand, even with all the economic anxieties floating around, it really underscores the dollar's enduring role as a global safe haven. It challenges those narratives of an imminent decline.
Okay, so who are the big players still holding U.S. debt then?
Well, Japan remains a major holder. They've got about $1.126 trillion.
And China. We always hear about China.
With China still significant, yes, with around $784.3 billion.
Yeah.
But what's particularly interesting and counters that dumping narrative is that China has actually increased its holdings recently.
Increased, not decreased.
Correct, which directly goes against any suggestion that they're aggressively selling off U.S. debt. Overall, foreign holdings account for roughly 30% of total U.S. debt.
Still a pretty solid chunk.
It indicates a pretty solid and significant level of demand, yes.
Now, what about this Treasury buyback program we've been hearing about? Doesn't that signal some kind of weakness or lack of demand that the U.S. needs to cover up?
The buybacks. It's important to understand the context there. Yes, the Treasury has conducted buyback operations. We saw some in April 2025, for instance, $8.5 billion, $4 billion.
Okay, so they are happening.
They are. But the main goal isn't about counteracting a lack of demand. It's primarily about managing cash flow and liquidity, smoothing things out.
How does that work?
They mainly target medium and short-term bonds. It's more of a routine financial management tool. Think of it like optimizing their own portfolio.
So it's more like regular financial housekeeping rather than a sign of a serious problem, like they can't find buyers.
Exactly. That's a good way to put it. And when you consider the sheer scale of U.S. debt, we're talking around $36.2 trillion in total.
Yeah, the buyback amounts seem pretty small in comparison.
They're relatively small. It's more accurately seen as a technical adjustment to manage the existing debt structure, not some kind of self-rescue because no one else wants to buy.
Okay, so the no one wants U.S. debt claim seems pretty unfounded then. How would you assess its credibility overall?
I'd rate the credibility of that specific claim. No one wants U.S. debt as very low. The data just doesn't support it.
But the buyback program is real.
Oh, yes. The Treasury buyback program itself has high credibility. It's happening. It's just a standard, well-established way to manage government debt. The key is why it's happening, and it's not because of insufficient demand.
Got it. Okay, let's switch gears now. Stocks and the dollar.
The more volatile side of things, perhaps.
We saw that noticeable downturn in early 2025, right? The S&P 500 fell, what was it, around 12%?
Roughly, yes. And the NASDAQ experienced an even steeper drop, nearly 18%.
Ouch. And at the same time, the U.S. dollar weakened quite a bit.
It did. Dropped noticeably against other currencies.
Now, some theories popped up suggesting this wasn't just market jitters, that maybe it was a deliberate strategy.
The imperial debt reduction idea.
Exactly. The theory being that a weaker dollar and maybe some inflation could help reduce the real burden of U.S. debt. Was this intentional?
Well, there's no doubt we saw significant market volatility then. The S&P 500 did fall from its high in late March.
Around 5,776.
Yeah, down to below 5,500 by late April. And as you said, the NASDAQ's fall was more pronounced, largely dragged down by tech stocks.
And the dollar?
The dollar index definitely dropped. It had been in the 108, 110 range in late 2024, early 2025, and it fell down towards the 99 level.
And what caused that drop?
Likely connected to uncertainty around potential tariffs, trade war fears, and also growing expectations that the Fed would start cutting interest rates.
Okay, so the market clearly reacted. But was this engineered? Was it a planned move to devalue the debt?
In theory, the mechanism works. A weaker currency and inflation can erode the real value of debt denominated in that currency. That's the basic economic concept.
But the crucial question is whether it was intentional.
Right. And intentionally triggering a significant stock market crash and devaluing your own currency. That carries enormous risks.
Like what?
You could severely damage investor confidence, trigger capital flight out of the country, maybe even tip the economy into recession.
Which would run completely counter to the stated goals of, say, the Trump administration at the time, which was focused on growth.
Exactly. Deliberately hurting your own economy to maybe slightly reduce the real debt burden. It just doesn't seem like a rational trade-off.
So what's a more probable explanation for the market dip and the weaker dollar?
A much more likely explanation is that the market downturn was a natural, albeit sharp, reaction to growing worries. Worries about a potential trade war sparked by tariffs.
So market fear rather than government manipulation.
There's no solid evidence to suggest the government intentionally orchestrated these market movements. It looks much more like the market pricing in risk.
Okay, so while debt dilution might be an objective consequence of a weaker dollar and inflation,
Yes, that effect can happen regardless of intent.
the primary cause seems more likely to be external factors and policy uncertainty, like the tariff situation.
Precisely. So how credible is the intentional debt reduction theory? I'd rate it low to medium.
Why not just low?
Well, the effect of debt dilution is real, objectively. But the lack of evidence for deliberate government action, combined with those substantial risks and conflicting policy goals, it makes it a much less convincing explanation for the cause of the downturn.
It seems more like an unintended side effect of the tariff uncertainty then.
That appears to be the more plausible interpretation, yes.
Okay, now let's talk about the institution everyone watches, the Federal Reserve.
The Fed, always central to these discussions.
There's a lot of anticipation, or at least there was, that they'd cut interest rates at least twice in 2025.
Right. And some were even suggesting they might need to restart quantitative easing QE to maybe stabilize markets or help manage the deficit.
So what signals were we actually getting from the Fed around that time, say spring 2025?
Well, the market's expectations were definitely a major factor. In their March 2025 meeting, the Fed actually decided to hold the federal funds rate steady.
Hold. After cutting before.
Yes, they kept it in the 4.25% to 4.50% range. That followed a big 100 basis point cut, a full percentage point, back in late 2024.
So they paused the cutting. What did Chairman Powell say?
After that March decision, Chairman Powell indicated the economic outlook was stable, but importantly, still faced considerable uncertainty. He specifically mentioned the potential impact of tariffs on inflation as a key watch point.
Makes sense. And what about the Fed's own crystal ball, their economic forecasts?
Their projections at that time actually included a downward revision for 2025 GDP growth, bringing it down to 1.7%.
Slower growth expected.
Yes, but they also increased their outlook for core PCE inflation. That's the measure they watch closely, up to 2.8%.
So slower growth but stickier inflation. What did that mean for rates?
Interestingly, their own interest rate forecast, the famous dot plot, suggested they still foresaw 2 rate cuts by the end of 2025.
2 cuts, bringing the rate down to
the 3.75% to 4.00% range. So yes, anticipating further easing later in the year, just maybe not as fast as some hoped after the pause.
Okay, so the Fed saw 2 cuts, but I remember the market seemed to be pricing in even more.
That's true. The market, judging by things like the CME FedWatch tool, definitely had a more dovish outlook than the Fed's own projections.
How much more dovish?
Probabilities were suggesting a potential year-end federal funds rate, maybe in the 3.50% to 3.75% range. That implies 3 rate cuts, not just 2.
So the market was more optimistic about slowing growth or inflation easing faster than the Fed was.
That seems to be the case, yes. Reflecting maybe more optimism or perhaps just pricing in more risk of a slowdown.
Now, what about QE, quantitative easing? Any hints they were heading back there?
Well, the Fed did announce they were slowing down their quantitative tightening program, QT.
Okay, slowing QT. That's the opposite of QE, right? Where they let bonds mature off their balance sheet.
Exactly. They reduced the cap on how many Treasury securities they'd let roll off each month from $25 billion down to $5 billion, starting in April.
Why do that? Is that a step towards QE?
The Fed stressed that this adjustment was about ensuring a smooth transition in the level of reserves in the banking system, making sure the plumbing works okay. They explicitly said it wasn't a precursor to restarting QE. Their balance sheet was still huge, mind you, around $7.2 trillion.
So slowing down the reduction isn't the same as starting to buy bonds again?
Not at all. Restarting QE, actually buying assets again on a large scale, would likely require a much more significant economic crisis than what was being forecasted.
Like a deep recession?
Probably. Given the outlook back then, slower growth, yes, but not a deep recession, and with inflation still a bit sticky. The scenario of the Fed firing up the QE machine again seemed less probable.
Okay, so summing up the Fed picture. Rate cuts seemed quite likely based on both the Fed and market views.
Yes, high credibility for rate cut expectations.
But restarting QE, much less likely unless things got significantly worse.
Correct. I'd rate the credibility of QE restarting as medium-low. Would likely take a much more severe downturn to push them back to that policy tool.
All right. Finally, let's try to decode Wall Street's moves amidst all this.
The big players, the institutional investors.
Yeah. There's this theory, this narrative, that big financial firms were basically capitalizing on that early 2025 market dip.
How so?
Buying up seemingly undervalued tech stocks, maybe some broad index ETFs too, while also holding on to safe havens like gold, all in anticipation of those Fed rate cuts, or maybe even QE.
And the idea is they plan to sell high later, maybe to retail investors.
That's often part of the narrative, yeah. The classic Wall Street playbook, some might call it. Is there truth to that? Were they playing that game?
Well, it's certainly typical behavior for institutional investors, hedge funds, pension funds, big asset managers to look for opportunities during market corrections.
Yeah.
That's their job, essentially.
Buying low when others are fearful.
Exactly. And tech stocks, despite the hit they took, often appear attractive due to their long-term growth potential. So buying them on a dip isn't surprising.
And anticipating policy shifts, like Fed cuts.
Absolutely. Anticipating looser monetary policy would naturally lead big players to position themselves early. And asset rotation may be shifting out of safe havens like gold back into riskier stocks as the outlook improves or policy eases. That's standard practice too.
So buying undervalued assets and positioning for policy changes, that's just normal institutional behavior.
Pretty much. And if we look at the actual fund flow data from, say, the first quarter of 2025, we do see some trends that align with parts of this.
Like what?
There were significant inflows into tech sector ETFs, around $11 billion. That fits the buying the dip in tech idea.
Okay, what about gold?
We also saw net inflows into gold ETPs, those exchange-traded products, tracking gold about $6 billion. That reflects the initial demand for safety we talked about earlier.
And anything else?
Interestingly, there were also huge inflows into fixed income ETFs bonds exceeding $100 billion. That strongly suggests anticipation of lower interest rates, which boost bond prices.
So tech, gold, and bonds were all seeing inflows. What about diversification?
Good point. We also saw flows into European and Chinese equities during that period, which suggests it wasn't just a singular bet on U.S. tech. It points to a more diversified allocation strategy.
That diversification seems to argue against the idea of a simple pump-and-dump scheme aimed squarely at retail investors, doesn't it?
I think that's a crucial point. The retail trap narrative often oversimplifies what's really happening. Yes, institutional investors make decisions based on macro assessments, and they aim to profit, obviously.
But it's not purely about tricking smaller investors.
It's unlikely to be solely driven by exploiting retail investors. Market prices are set by the interaction of many different participants. While individuals might sometimes have less information or react differently, it's probably not accurate to portray it as a unilateral manipulation by institutions.
So while the big players are definitely looking for opportunities and acting strategically,
It's not quite the straightforward, potentially exploitative plan targeting mom-and-pop investors that some might imagine.
exactly. So how credible is this overall Wall Street playbook narrative?
I'd rate the credibility of the general pattern institutions buying dips, anticipating policy as high. That's standard behavior.
But the specific Q1 actions solely supporting a dump-on-retail scheme.
The credibility for that specific interpretation, based on the Q1 data showing diversification, is more medium. The evidence suggests more complex, diversified strategies were at play, going beyond just loading up on tech to offload later.
Okay. So to sort of bring this all together, wrap things up, it really sounds like the U.S. financial landscape we've been discussing is less of a pre-written, directed script.
Yeah, not some grand conspiracy playing out exactly as planned.
And much more of a dynamic, continuous interplay. You've got proactive policies, yes, but also market reactions, global events feeding back in. It's complex.
That's a very accurate way to put it. I think the idea of a single, all-powerful financial script really overestimates the level of control policymakers actually have, even in the U.S.
So the reality is more about...
The reality seems to involve the U.S. leveraging its inherent strengths, the dollar's role, the depth of its markets to navigate challenges. But the market's own reactions to global developments, from geopolitics to trade fears, are equally critical in shaping what actually happens.
It's a two-way street, or maybe a multi-lane highway.
Definitely, not a one-way dictation.
So looking ahead then, what are the key things you think we and our listeners should be keeping an eye on?
Well, a few things stand out. Definitely the final form and actual implementation of any new tariffs. How broad, how high, the retaliations. That remains a huge source of uncertainty.
Okay, trade policy, what are
The Federal Reserve's ongoing balancing act. Can they successfully thread the needle between controlling inflation without stalling economic growth too much? That's always crucial.
the perennial Fed challenge?
And of course, any major geopolitical developments. Unexpected events could easily shift market sentiment and trigger new safe haven flows or risk-off moves.
Always the unknown unknowns. Okay, so here's a final thought maybe for you, the listener, to chew on after this deep dive. Consider how the deep interconnectedness of global markets really amplifies all these dynamics we've talked about. It seems like no single nation, not even one as influential as the US, truly operates in isolation anymore.
That's absolutely right. Actions have ripple effects everywhere, instantly.
So this constant state of reaction and adaptation seems to be the defining characteristic. What does that really imply for you as an individual investor trying to navigate this incredibly complex environment? Something to think about. Thank you for joining us. See you next time.